Thanks, Marco. This is a great risk reward situation. The CEO creates a love or hate relationship with the stock, and that, frankly, creates opportunity. Let's just dive in. We're going to do things a bit different this time. Instead of stock charts, I thought that I'd use the economic cycle to make my case. It's a conceptual chart that shows booms and busts, from recovery to boom, to recession, to depression, and then back again. You can see over time, it tends to trend higher. Keep in mind that these booms and busts can and usually last multiple years. Now, we are somewhere here with the stock trading $21, coming out of a tough last 18 months. We're still traded near $400 last year at the lows, and now it's trading near $1,800. The question we're facing is, where do we go from here? By the looks of this chart, we might be heading lower. In the background, we have inflation moving higher and the possibility of the Fed tapering, which would raise interest rates and slow the economy. You also have the risk of COVID-19 Part 2 with this Delta variant. It appears that the market is reducing some equity exposure until there is a clearer picture on that front. So let's take a look at CLF as a company. This year, they'll likely produce somewhere between $5 and $6 billion in free cash flow. They currently have an enterprise value of about $17 billion. Let's showcase the debt part of that number, which is made up of approximately $5 billion in debt and $4 billion in pension liabilities. Now, if we look at EV to free cash flow, we get something like 3 times. 3 times looks great, but if we get back down to $400 steel, free cash flow gets wiped out and that 3 times goes a lot higher. Not so great. In that environment, $21 would look expensive. CLF could easily trade $14 or even lower. But there is also something very bullish lying in the background. President Biden's broad $1.2 trillion infrastructure plan that would extend over 8 years. This plan would undoubtedly include huge purchases of steel. And just saying, when has construction of highways, bridges, and airports ever gone according to plan? My guess is that it will ultimately need more money and more time. So if this infrastructure plan gets passed, then you may have something that looks like this, where the US government becomes the buyer of steel and fills the void of lower steel industry revenues and earnings created by the slowdown from either higher rates or the Delta variant. This would allow the next recovery, whenever that is, to start at a higher plateau. What might free cash flow look like then? Well, let's say it's a bit higher at $7 to $10 billion because we still have the government demand and now the economy is adding to the revenues. And debt? The CEO has stated that he plans to take debt down to 0 by the end of 2022. With $5 to $6 billion in free cash flow this year and possibly next, you could easily see how he gets there. You can then start guessing what this enterprise value number might be. $7 to $10 billion in free cash flow with no debt, which gets you a $40 to $60 stock. And keep in mind, 3x EV to free cash flow is generally low, so imaginations could run wild here. Now let's talk about options. I'll show you a put idea in case this infrastructure plan somehow gets derailed, or the Delta variant comes at us with full force and the government goes into lockdown mode. I chose a September expiration to give us some time for that to play out after the earnings next week. We can shade the call side here. And I chose $14 as a target stock price with a drop in my confidence level there to 60%. I'm lowering my confidence level because it would be a very steep drop, and frankly, I don't think there's a high probability that the government will go into lockdown mode. The pointer lands on the $19 strike at a $1.49 cost, which seems reasonable as it would offer me a 236% ROI in this negative scenario. But I want to be upfront here. I think the leverage potential is to the upside. While we have no idea what will happen, I certainly don't, we can see that if the positive scenario plays out, then the stock could explode. I do think we need some time though. So I'll choose the January 2022 25 calls with a target stock price of $40 and an 80% confidence level. If the positive scenario plays out, I am more confident in my assessment in how the market will value the stock. At $40, this gives me an ROI of 460%. There you have it, Marco. The bull and bear case with a very wide macro backdrop that will decide whether CLF crashes or explodes higher. Back to you.